being rich is not true wealth. Less than 3% of wealth passed lasts more than 2 generations.
Psychology of that is so important. I mean, this is hundreds of thousands, even millions of dollars that you're wasting.
Decision fatigue is a concept we talk about a lot, and this comes from when you have uncoordinated life. Tax planning can save you literally millions of dollars or double or triple your net worth over time. The most important one that most people don't have is that's the biggest risk that exists out there right now. Welcome everybody. Today, I'm joined by Ben Redenberg, and we are talking about the drains that occur in wealth building. And these drains are not just money leaks. They are regret. They are the form of, wasting time. Sometimes what you own ends up owning you. So we're going to talk in great detail how you can avoid this and what the biggest silent killers are. So, Ben, what do you typically see as the number one drain in a financial plan?
One of the biggest drains that I see is just general lifestyle creep, or just not having a system in place for saving and spending, and then things just get unorganized and you don't really have a control of what is coming in the door and what's going out. I think a good example is setting a thermostat in your room. If you just bump it up 2 degrees, over time, you might feel it initially, but if you just keep it like that, you almost get used to it and it becomes normal for you. And I feel the same way about financial planning and just money management. If you get used to a level of spend and you don't rein it in and you don't have a plan around it, it just becomes normal, and it's easy to get stressed and unorganized about how much you're spending and where your money's going because you don't have a system in place. So I would say just general, feeling your lifestyle go up, but not having a plan in place around it.
Yes, I would say that I completely agree. The catastrophe in a financial plan is one of two things. You've lived such a good lifestyle, but every decision you make is full of stress because you haven't saved or secured your future. And then there's the other end where you have the best savers who save everything. They don't enjoy life. And then by the time they, retire, they have health problems, they die in 2 years, and then they spin off a whole new set of problems for their kids. So
they saved all this money to use for retirement, and their health fails and they don't get to use any of it.
Yes, I think a good financial plan is letting that lifestyle creep occur, but with intention, and making sure you have a calibrated financial plan. So I'll give you an example. There's a gentleman we work with, his family, they were originally planning to retire. Well, not retire. He's a very motivated individual. Probably is going to work for the rest of his life, business owner. Originally set his plan at $10,000 a month. And so, we set a liquid net worth goal of, we need about $3 million is going to be safe, safe withdrawal rate, net of taxes. And, literally 3 years later, his business exploded and he was spending $60,000 a month. Now, $60,000 a month was still 1/4 of what he was making, but when we evaluated it, it's actually much more. So when money comes in, if you don't kind of call shotgun on where it goes, if it's getting saved or spent, it just kind of leaks through the cracks, and before you know it, anything that doesn't get saved intentionally typically finds a way to get spent. So not saying it was wrong for them to spend $60,000 a month, but the lifestyle creep needs to be with intention. It can't be controlling you. You have to control it. And I think we talk about you should move the goalpost. The higher net worth, higher income you get, you don't want to keep a static financial plan of spending. I'm going to spend $10,000 a month and you're making 50. Now you're saving 40 a month, and you're going to way over accumulate your net worth. And you're going to have all this kind of regret of stuff you could have done with your family along the way.
Yeah.
So
can we unpack that more? I think that's super interesting. So they're spending, you had it modeled out at $10,000 a month. Everything was fine. They're spending 60, but they're making more than enough to spend that. Where was their head at? Were they oh my God, we're spending too much? Were they is this enough? How did you assure them, or how did you get them?
So we had to recalibrate the plan, obviously. Now we needed a net worth, and there was some stuff that involved his kids. So by the time the kids were out of the house, they would have needed about 40 months, about $500,000 a year. And so we had to adjust that liquid net worth goal from 3 million, I think, to 11.5 million to sustain. And this is, again, is a financial independence plan, not a typical 65 live till 95. This is we want this by 50, and we need it to last 40, 50 years. So we had to adjust. And I think at the time he was making 3 to 4 million. And so, net of taxes, he was fine to spend that 60 a month, but we really had to start saving the equivalent of 60 or 70 a month to create that financial independence within, I think it was a 10-year window. So what was an initially like super on track financial plan, we're going to be financially independent in 5 years. If he had retired in 5 years at that lifestyle, he would have like run out of money by 55. So we see this all the time. I'm just thinking of another client we met last week. They had, for years they had been very disciplined. They're basically, had big bonuses and stock bonuses that we would save, and they were basically living off of they're netting about $12,000 a month as a family, like net after taxes. And so they were spending all of it, but they were saving most of the bonuses. So we're like, okay, $12,000 a month. Now they had done such a good job, they were going to retire at 60. And so there's a gap of 5 years they would need health insurance. And we add the $12,000 a month we know they're going to spend plus the health insurance. So that's another probably $2,000 a month to bridge that gap until Medicare starts. Then plus we had evaluated, so they're between their cash bonus and their stock bonuses, they were saving like $200 to $250 a year. But when we did an audit of it, they were pulling back about $50 a year in upgrading the kitchen in the vacation house, getting, a new, putting a pool in the backyard. And so we had averaged out these kind of like out of the $12,000 a month other cost that occurred over the last 5 years, and that averaged $50 a month. So originally the assumption was $12 a month, then you add health insurance for early retirement, then you add another $50 a year. Now we're looking almost close to $200 a year. Now these clients were fully on track for that still at age 60, but it's definitely a completely different dynamic, and telling them like their guardrails of what they could or couldn't spend, or like the expectations of what they can gift their kids along the way, changes when you do that real audit. So I don't believe in like retire off of 60% of your income, or like, you need to do like a hard life audit on like what are your fixed costs, what are your variable costs, and then what are like the unknown costs that you say are never going to happen again. It's a one-time thing, but those one-time things happen every year.
Right. I think that's a big misconception. I think you'd agree is if someone spends $25,000 a month in their working lifetime, I think it's easy to think, oh, I'm retired, my kids will be out of the house, my mortgage will be mostly paid off, I could probably spend $15,000 a month. In your experience, do you find people are spending very similar to what they're spending in their working lifetime and retirement?
I think that if you've done it right, you're spending more on retirement, right? Because you're basically, if you're working, you have 40 hours a week that you're not able to spend money if you're actually working. Now, some people are probably purchasing stuff on Amazon during the day, but you retire and you have all that freed up time. The more free time you have, now, yeah, your kids are out of the house, but now you have grandkids, and you're probably going to spoil your grandkids more than you did your kids, right? So typically we found for our kind of clientele, higher net worth, like that 3 to 5 million net worth, you're typically going to spend a little bit more in retirement. Or you're that great saver, and we're coaching you now to say it's okay to spend a little bit of your money. You don't have to split your Chipotle bowls when you go out anymore. So anyway, so I think just to reframe number one, the lifestyle in a creep is a bad thing. That controls you. I would coach any client that's a high income, high net worth, that's done a good job of financial planning. You need to, lifestyle escalation is a healthy thing as long as it comes with a calibrated financial plan. So you know what the cost of not spending more is, you're over accumulating, what the cost of spending more is. Are we still on track for financial independence? Are you still on track for giving money to your kids? Whatever your goals are. But to hit that balancing act, I would say less than 10% of the population is in that. And that's our goal, because most financial advisors would just say keep saving, because it, more assets under management. But, we don't want to have any regrets. I would define that as a failure in a financial plan just as much as under accumulating and
Sure.
not being.
Total balancing act. It's hard to save for the amount you need for the mid and long term, but balancing enjoying life today, I think that gets lost in a lot of financial plans.
No question. All right, so let's go to number two. So I would say number two is really about if you're high net worth, high income, and the peace of mind that you think you're going to have when you have the money thing figured out, it's not there. In fact, it can magnify any insecurities that you have or any tendencies that you have. So I think it's really important to make sure that your money is supporting your life by design. And decision fatigue is a concept we talk about a lot. And this comes from when you have uncoordinated advice, when you have an accountant telling you to do this, when you have an estate planning attorney tell you to do this, when you have your two financial advisors, you're comparing performance, and you have like an insurance broker and you're getting 5 different things thrown at you, 5 different ideas.
And you're having 5 meetings too. Your time is valuable. It's 5 separate meetings. Yeah.
And, this isn't your field, so you're just getting confused with all these different recommendations. So uncoordinated financial advice, I would say, is just, It's really the worst kind of even financial cost, because you're wasting your time, and that's the only non-renewable resource we have. So yeah, maybe you're not leaking money. I would say you are leaking money because you're probably overpaying in fees by having stuff spread out. But the time you're in the decision delay that's occurring because of this can be catastrophic, especially because why not have peace of mind if you can do so with a good financial plan.
Yeah. A lot of those professionals just feel like, hey, I'm giving my advice and like kind of, my job's done, but actually seeing it through, I think is just a huge value add. So if you have a team, or if you have someone that is actually not just telling you what to do, but then actually helping you do it and getting it done for you, that's the biggest thing. You can have the greatest estate planning meeting and greatest tax planning meeting of your life, but if it's just information that you have and you don't act on it, what was the point? It was a waste of time for everybody. So actually, like, not just getting the right information, but having the team that's actually helping you see it through is valuable.
No questions. That is the top bit of bow on this. So hidden cost, time spent coordinating others' opinions, decisions delayed due to confusion or you're second guessing because of the different opinions, or regret when misalignment leads to misstrategies. So, that's our job at EWA. We try to act as that financial CFO, even that COO. You're the CEO, but we're handling as much as we can, taking the noise away for you so you can focus on what matters in life. Okay, so that brings us to segment 3, which I would say is all around taxes, tax drag. So Ben, what would you say about this?
Yeah, I would say just having a plan in place around it. The last thing that we would want is someone having an unexpected tax bill, or just you file at the end of the year and you owe a bunch of money that you didn't really know. So having that proactive tax planning throughout the year, running projections on your income, making sure you're on top of your quarterly payments if that applies to you, really having a full understanding of your tax picture, and then doing the right action items to take advantage of, maybe like if you have a low income year, doing a Roth conversion, you're taking advantage of tax loss harvesting. If maybe you're in a direct indexed account in your non-qualified brokerage account. So just not just having a tax person that does the return and you talk to them once a year, but having a coordinated plan around, hey, I'm in a high income year. What are we doing about it? I'm in a low income year. What am I doing about it? Am I taking advantage of all the things I should be? That just relieves a lot of stress knowing that you have all that taken.
So I'd say 3 examples. A good tax preparer may be able to save you a couple thousand, or maybe even 100,000 if you're high income earner that year. Tax planning can save you literally millions of dollars, or double, triple your net worth over time. So examples of that would be if you're being disciplined with tax loss harvesting. Those you get to carry forward with you for the indefinite future. Those can offset real estate sales. Those can offset business sales on a capital gain level.
Private equity investments
that hit. So, you can eliminate tax liabilities by having a disciplined strategy and if you look at the turnover of the S&P 500 of just like what makes up the good returns, what doesn't, there's going to be hundreds of companies every year that you can tax loss harvest if you're in that direct indexing strategy that we always talk about. Roth conversions you mentioned during low income years, and that leads right into number 3, which is if you don't do anything, AMT, IRMA charges when you're trying to unwind your portfolio, and your Medicare costs are going to be based upon at least Part B and Part D are going to be based upon actual modified adjusted gross income, which could be astronomical if you look at your Social Security, if you look at your required minimum distributions from IRAs, if you look at dividends and capital gains getting spit out from non-qualified account, and then you add in the fact that all those factors, you climb through those brackets so quickly, and suddenly your health insurance is one of the biggest part of your balance sheet, or one of the biggest part of your budgetary commitments. So there's a difference between tax preparation and trying to get that nailed down the year, and then tax planning, which can compound in the right direction if you do it the right way for the rest of your life.
Yeah, this is why a 10% return in a Roth account is not the same as a 10% return in a pre-tax account. If you have a team that is not just worried about the rate of return and is worried about the plan as a whole, you have a much better understanding of where your actual tax situation is and how you're dealing with it.
Absolutely. So I would say number 4 would be illiquidity. So illiquidity, this is, especially high net worth, everyone can invest in public stocks. Private credit, private equity, getting more popular. Maybe there's a friends and family investment that you did. Maybe you're doing real estate. So a lot of high net worth families do have a lot of their wealth trapped in like real estate, business ventures, private investments they've made. And a lot of these things actually consume your time, consume your money. They require capital calls. Real estate constantly requires, maybe it's tenant turnover, repairs and maintenance, whatever it is.
Just to back up on that, capital calls. So let's say you put 100,000 in an investment. You might think, hey, that's your only That's a one-time thing. We'll see what happens. But then it's additional calls. Hey, we need 25,000 here, 50,000 here. Stuff you might not necessarily have planned for.
Yeah. So you have you typically have the option that you can dilute your percentage that you own, or you have to keep funding money. And I've seen some private investments. There's been like three capital calls over a 3-year period. So what initially was supposed to be for a client, a $250,000 investment has now turned into a $400,000 investment on a highly speculative type of investment that may not hit at all. So now if it does, it could be really big. But just for number 4, liquidity is so hard to do. It takes so much discipline. It's not sexy in the way like a brokerage account is just sitting there. It's not something that anyone's going to see, which I would argue is the best thing in the world, because that's, true wealth is stuff you can't see. Being rich is not true wealth. The cars, the houses that, you can see visibly. But the reality is it takes so much discipline to take after-tax money and not spend it and then save it, or, not fall into the influencer thing that you saw on social media, or this fancy real estate deal that 12 of your buddies are doing. It takes a lot of discipline to say no and to keep piling money. But we've evaluated like thousands of balance sheets. I would say 95% of the time, when we look at all the clients who've done all these fancy private investments, they would have like literally had double their net worth if they had just done traditional diversified like ETF investing over their life, and not put 100 here, 250 here, $500,000 into this real estate thing. If they had just stayed to the plan, they would have double the net worth.
The math sounds so simple, but is it just boring? I mean, why don't
there's like I think it's just how our brains are wired. There's no dopamine hit when you save money automatically into a 401k. When you're talking about a brand new real estate thing that could hit big, or you're becoming a minority investor in some fancy thing, it's just exciting. And it's good temporarily. It's horrible for you long term, typically. And then one thing hits and you get addicted. It's kind of like
gambling.
Yeah, or your golf game. You like have an offer round, you hit one good shot, and you're like, you think you're going pro. So number 5, I would say, is all around risk exposure. So this could be, around legal structures, around insurance. We also coach our clients into, you want to find a balance. You don't want to be so insured that it's costing you that, and you don't want to be underinsured. So there's a balancing act. So Ben, why don't we talk about that?
Yeah, I think, from a life and disability insurance standpoint, making sure you have the right amount of coverage, the right type of coverage. You could have the greatest financial plan in the world, but if you're not earning your income that we're planning on, like if you're disabled, you're not able to work, then all of it's gone. So we need to make sure, like you said, we have the right amount and type of insurance coverage. And then from a protection standpoint, making sure you have the right amount of umbrella coverage. Just protection as a whole is super important. We always say, like, there's offensive planning and defensive planning. Like, we can't be all offense and have no defense, and the insurance is just that defense to protect you.
A good financial plan, you got to have your disability covered through work, even some supplemental out. You got to have a good life insurance plan to make sure your family's protected. If you do super well, the life insurance can be a huge part of your estate planning. Obviously your homeowner coverage, your car insurance, those things you have to have. So most people have that. But I would say the two things that most people miss are, you got to have enough certain liability protections underlying your car and home. So you can add this umbrella. You always want to have an umbrella. Caps at $5 million. Most of our clients will get to that $5 million. You should have that. In most states, you want that equivalent to your net worth or round it up. The other thing that's, I would say, is the most important one that most people don't have is purchasing additional cybersecurity insurance. I think that's the biggest risk that exists out there right now. It's growing exponentially, the amount of crime that's occurring, and just securing your, where your money is on these different platforms. So, okay, well, let's go to number 6. So, and by the way, cybersecurity insurance, you can just contact your insurance agent that does your homeowner's policy, and it's typically, it needs a $250 you can add. That's pretty cheap.
Sure.
Do that. Something recently I did. Okay, so number 6, I would say, is the cost of holding cash. We see this very common in the medical space, very common with business owners. There's a lot of uncertainty in life. If you're a high-performing, high-income individual, there's a lot of noise around next market crash is always around the corner. So first of all, market timing is impossible. Getting out or back in. No one has been able to do that consistently over time. And so, you got to be the house of the casino. There's going to be ups and downs, but the house always wins. And the analogy there is you get in and you stay in, right? If you go play in the casino, eventually you're going to lose money. You may hit it big one time, but that we refer to as timing the markets. Once you're in, you got to stay in. So with that being said, we would recommend, if you have cash, put it in. Don't think about the market being high or low. we've done a podcast specifically on, do you put it over time? Do you put it in a lump sum? What are the probabilities around that? But if you have concerns about needing liquidity, one strategy, if you put into a normal non-qualified brokerage account, you can gain access to that liquidity right back through a line of credit. So if you keep $1 million in cash in a savings account, maybe you're earning 3 or 4% right now. That 3 or 4% is giving tax at ordinary income rates of probably 40% if you're in Pennsylvania, 37 federal and 3% state. The 4% goes to 2.6% net return. Or you throw it in a stock account. Historically, you're going to get 7 to 8% in a diversified stock account. And then you're able to get 65% of that back in liquidity through a line of credit. So on a year you don't need it, great. It's just growing. You're not paying taxes because you're deferring all the capital gains, and you're letting your money grow long term. If you do need it, you have this line of credit that you can pull from temporarily. A line of credit costs you nothing if you never use it. If you need it, you're going to pay interest. Typically that interest is going to be less than the growth of the stock account. So you've just arbitraged the returns of giving a bank, letting the bank earn a bunch of money on you. You're getting those returns. And on a year you need it, maybe 1 out of every 5 years, you got the liquidity. You're avoiding taxes. You're avoiding market timing. So you're not actually selling out of the stocks. You're letting that line of credit go to work and then putting it right back when the time comes. But I think that's a really important way to get around the fear of I want to hold cash because of X, Y, Z.
The psychology of that is so important. I mean, this is hundreds of thousands, even millions of dollars that you're wasting, because I think there's always going to be a reason to talk yourself into waiting.
Yeah.
There's always going to be a reason to say, well, I'll start this next year because I got to do X, Y, and Z. And then next year rolls around and, well, this came up and then blah, blah, blah. Like there's just always going to be a reason. You run the math on even just waiting 5 years on starting your financial plan. We're talking about hundreds of thousands, even millions of dollars that you are essentially losing in compounding interest by waiting. So I agree with you 100% there.
I'd say the last one, number 7, would be legacy uncertainty. So, there's a reason like less than 3% of wealth passed last more than 2 generations. So having the tough conversations, what values impact, what's the structure for your kids? The thing that made you successful, sometimes like the adversity, the hard work, if you just give the money to your kids without that, their ability to experience that, you're going to ruin their ability to achieve what you've achieved.
Yeah, you want to help them, but not enable them. I think that's a hard balancing act. And I think it's hard to have those conversations with your kids about what your net worth is like, how you got your money, why the values that led you to that point are so important. But unfortunately, we've seen those conversations not happen, and kids inherit a bunch of money and they have no idea what to do with it. They have no idea how hard their parents worked for it, and we've seen it go to waste. So we always say hard conversations lead to an easy life. These are part of those hard conversations around estate planning for sure.
Yeah, and money is sometimes represents power, and so sometimes you see that there's a lot of money being passed on. We see sometimes families will look at, well, play favorites, or kind of say you need to do this or that, or I don't like the marriage you're in, or we hear it all. I mean, and so the reality is like an unclear estate plan can really ruin an entire family dynamic. It can make things ingenuous. We've seen a lot. So having a clear estate plan, eliminating family confusion, just having those really tough conversations, while you're living. And then I think also having your philanthropic intents in writing is really important as well, and discussing those with your kids before you pass. And then I would say for business owners, like the succession planning is just crucial. Don't wait till the last minute. Make sure you're addressing that, because that's where a lot of leakage can occur in your wealth plan of continuing the enterprise value that you built in your business. So
yeah, I think people think high net worth people have all these things figured out, but these are all risks to someone's financial plan, regardless of your net worth. And so the earlier you can address a lot of these issues, the smoother all this will be.
Perfect. Well, thanks for joining us. We'll catch everyone next week.